Okay, now that we've covered our global risk nexus and discussed the economics, politics, policy, and markets, particularly from a top-down asset class perspective, what are the top trades? And the good news is that I have five top trades for 2017. And even better is the fact that we have ETFs to express all of these trades. And ETFs, of course, from an asset allocation or portfolio construction point of view, are simply a wonderful vehicle for investors, be they institutional or individual, to use to express their perspectives on financial assets. It's really one of the, in my view, one of the great developments of the last 10 or 15 years in investing. So my first top trade of 2017 is to go long hedged Japan equity. And my ETF for this particular trade is DXJ, symbol DXJ. And the idea here is simple. Japan is going to return to inflation in 2017, and that is going to lead to a significant asset allocation shift within domestic portfolios. Part of this has already taken place over the last couple of years, but has really been retarded for most of 2016. This trade really wasn't really the place to be. Going forward in 2017, I believe it will be. We will go back into inflation in Japan, as we've already discussed, and DXJ provides exposure to Japanese equity on a hedged basis, so you don't suffer from the weakness of the yen. In fact, it's a benefit. The other benefits to Japan are, of course, a cheap stock market. Stocks are very undervalued. They're also very underowned, particularly by foreign investors. And Japan is really a play on global growth. So as we discussed earlier, global growth is picking up, albeit marginally, and Japan should be a beneficiary of this pickup, particularly their corporate sector. And finally, the corporate sector is acting much more in a traditional kind of Western approach to governance, to focusing on things like return on equity, to generating dividends. All these things are supportive of a long equity position in Japan, and given the outlook for the currency, one would want to be hedged, and thus DXJ. The second opportunity in trade, as I see it for 2017, is to be long U.S. small caps, symbol IWM for the Russell 2000. And here it's also quite straightforward. Small caps avoid the trade uncertainty that is roiling relations between U.S. and some of its trade partners. It also, the small caps also avoid the strong currency risk, which I think could affect the large caps in the United States and their earnings as they translate weaker foreign exchange earnings back into dollars. That's not going to help the large caps earnings. Small caps are immune from that. Small caps also benefit from the deregulation that's likely to come about in a Trump administration, as well as the potential for a Trump administration to really focus on buying American, particularly for any infrastructure programs that will come about over the next couple of years. So the second trade idea for 2017 is buy U.S. small caps, symbol IWM. The third opportunity switches gears from equities to fixed income. And so we've had a foreign equity position in DXJ, we've had a domestic U.S. equity position in IWM, and now we're going to add a fixed income position in U.S. high yield, symbol HYG. And here the case is also straightforward. High yield is an opportunity to generate yield, and there continues to be the search for yield that has been in place for several years. This is most evident through the incredible amount of issuance that we've seen already just in the first month of the year in the most risky part of the high yield market, which is the CCC market. And CCC issuance year to date through 2017 is up fivefold from where it was a year ago. And there's nothing better to suggest that the search for yield continues than statistics like that. So the third trade is HYG, U.S. high yield, to pick up that yield, which will also benefit from a fairly benign U.S. economic outlook. The fourth trade is going back outside the U.S., but this time to Europe. And the trade is to buy European banks, and the symbol is EUFN for European financials. And the opportunity here is simple. The financials are the most beaten up sector in Europe. We are past peak bearishness for Europe, in my opinion, and therefore the financials in Europe are the best way to play. They're also very cheap. They're also very owned, even by dedicated European equity investors. There's an underweight to the sector. European financials will benefit from rising rates. Sovereign European rates are now at a one-year high. That's good for the European financials. And in addition, they also benefit from the perspective of following the U.S. financials in terms of looking at how they would respond to inflation and to higher interest rates. So the fourth trade, the fourth idea for 2017 is European financials, symbol EUFN. The final trade of our top five is one that's really quite contrarian, and that is to buy Mexican equity, symbol EWW. And here, again, the perspective is fairly simple. In a world where many things are fully priced, and some of the trades that we've just mentioned have already had fairly significant moves in the past couple months since this outlook was first produced, Mexico has not. Mexico obviously has been under significant pressure with a lot of verbiage from the Trump administration. The Mexican peso has fallen roughly 15% since President Trump was elected, and that makes Mexico more competitive. It means that the risk reward is, I think, pretty attractive in Mexico. The risk is high, but I think it's quite well known. The rewards, therefore, can also be high. Because if some of these risks don't materialize, and if, for example, President Trump decides to not try to eliminate NAFTA or terminate NAFTA, but to actually enhance it and improve it, update it, and perhaps even extend it further southward into the rest of South and Central America, then you would see a very significant repricing of Mexican assets, which at this point the equities are cheap, the currency is very cheap, it's at 3 standard deviations away from its 10-year average, and all the bad news is very much in the price, barring one thing. If significant tariffs are enacted on the U.S.-Mexican border, then I think the peso and Mexican financial assets would have another leg down. However, I think the interdependence of the U.S. and Mexican economies, particularly in the auto sector and the white goods sector, is going to mean that cooler heads will prevail and that tariff threat will not materialize, and Mexican equities will be one of the better performing assets in 2017. So there you have it, the top 5 trades for 2017.